continue with Chapter 1, Introduction and Administration of the Income Tax Act. And I know we've looked at some quizzes. Just to do a recap quickly before we start with the part that we need to continue with today. We looked at certain quotes, and I like the one here where we said, I hate paying taxes, and if you've worked before, or if you spoke to someone before, you would actually understand that it's really not, it feels like it's not a nice thing to pay taxes. However, we said paying taxes actually bring civilization. And then we answered the question, why do we need to pay taxes? We said for the government to rebuild the country or to build the country and to create an environment in which all of us can prosper. Then we said governments create circumstances which ensures the maximum favorable living standards for all citizens. And I want to reiterate the word all citizens, not just some, not just the elite, not just you and me, even the person standing in front of a shop that asks for money, even they pay taxes. Now, some of you will probably frown out to say they don't pay taxes. Guys, you will see today when we look at the different taxes, which is direct and indirect taxes, and the indirect tax, VAT, is also a tax. Now, if someone that asks money from you, if they take that money and they buy something in the shop and they pay VAT, then automatically they have also paid tax, and therefore all citizens should be protected. And we spoke about some of these favorable conditions or favorable living conditions. We said national security, law and order, infrastructure, and things like that. Then we spoke about South Africa having the residence-based tax system. Guys, this is just a recap. It's just a recap. And we said residents in South Africa, based on this residence-based tax system, will pay tax on their worldwide income. Guys, this word is so important. If you are making notes, this word is very important. They pay tax on their worldwide income. And then we also said non-residents in South Africa. So if you as a non-resident work in South Africa, you will pay tax on the source or deemed source in the Republic. And we spoke about the Republic. Republic just means the Republic of South Africa. Remember that we are dealing with South African tax this semester, and that's why it's important that you use rands and all of that when we actually start calculating figures. Now, guys, it seems like tax is a very theoretical subject. It's not. It's actually, we need to build to get to calculations and all of that. But you can't do calculations if you didn't get the background, if you didn't get the theory, because it is the theory that will guide us to make the correct or to calculate the figures. So we need the theory, and you will see every lecture. It seems like tax is a theoretical law question, a subject. It's not. It's actually not. We need to calculate figures. We advise our clients on opinions and things like that. Okay. So we spoke about the history of taxation, and we looked at violence and nudity. And the very important lady there is Lady Godiva, who actually, she's actually a hero, if you want to call it that. And that was in the 13th century when she actually fought for the villagers, to pay lower taxes. So we can see that taxes have been around since the 13th century already, where even slaves and all those people had to pay taxes, and this lady tried to reduce the taxes. And we will also speak about reducing taxes a little bit today. Then we looked at the violence part of the history of tax, and we said that taxes were actually charged to finance wars. Okay. Then we looked at when did the first tax or first income tax arrive in South Africa, and we said that is 1814. Now, guys, this is very important dates. You need to study them. A lot of our questions will probably be, or some of them will be multiple choice, and these are good questions where we can ask you, when did the first income tax arrive in South Africa? 1814. And then we spoke about poll taxes and all of this. We looked at what happened after the First World War, when the introduction of super taxes and express profits duties were also actually introduced during the First World War. And then, guys, we looked at bachelor tax, betting and racing taxes, and also at environmental taxes. And guys, that is where we ended on Tuesday. Today we will continue with this slide, which is still the history of taxation. Now, guys, they say that in African tribes, people made a tribute in meat to the chief of the tribe. Now, it was not clear that back then if this was voluntary or if it was a duty by the chief. So it should not be B, but by the chief. Now, guys, the moment it becomes a duty to the chief, then it is regarded as a tax. But if it's voluntary, if it's just you donating the meat to the chief, then it is actually not a tax. Now, they say that back then it was not clear if this or this tribute in meat to the African chiefs were actually a tax or if it was not a tax. Okay. Now, guys, we will also look at the nature of income tax, and this is now the administration part. How do we administer, or when or why do we have to administer the income tax? And guys, we are dealing, this semester, we are dealing with the Income Tax Act 58 of 1962. Now, I'm sure you will agree with me that we cannot just blindly follow the 1962 Income Tax Act anymore, because there were several changes that were made over the years, because what was relevant in 1962 might not be relevant in 2021. But the origin of this income tax is the one that was set in 1962 in Act 58. And obviously, I just want to add that we will also look at all the amendments over the years. Okay, so the Income Tax Act of 58 of 1962, once again, a good multiple choice question. In which year did South Africa actually draft their Income Tax Act? Then you need to tell me in 1962. Now, this Income Tax Act, or South Africa imposes the following taxes. So this Income Tax Act imposed the following taxes. Now, guys, here we have different types of taxes, and I explained to you guys why we actually do South African tax, because they have almost all the taxes is applicable in South Africa, and as a good global citizen, someone that wants to work, some of you need to apply for the B360 to go to Switzerland and things like that, so that you can also go check out what type of taxes do these people pay that side, and things like that. But just to reiterate, the fact that we want to be global citizens means that we need to know what type of taxes are out there. Even though Namibia does not have half of these taxes in Namibia, we still need to know them, because Namibia might introduce some of these taxes later. And guys, this list is not exhaustive. It's not full, it's not complete. There is even more, like the one that I can't see here is, for instance, dividends tax. South Africa does have a dividends tax, currently at a rate of 20%. So this list is not full, and that is why you need your prescribed textbook so that you can read through your prescribed textbook. So some of the taxes that were imposed by South Africa, let's have a look at them and just confirm to me if you guys are still fine, you can hear me, you can see my slides.
Yes, we can hear you.
Yes, sir.
All right, thank you. So some of these taxes are, the first one is normal tax. Now guys, you will probably wonder about the names of these taxes. So just know that there's one called normal tax, and normal tax is levied on both individuals or natural persons and also on corporations or juristic persons. So normal tax. Then there is donations tax. In South Africa, they have donations tax. How it works is, if you give me a donation, you need to pay tax, because the argument is you really have money to donate, so please give us some money too. That is what the government say. Then withholding taxes. There's also withholding taxes. There is turnover taxes, and small corporations normally pay, and we will look at what is a small corporation. They normally pay turnover tax. Then we have value-added tax, and I indicated there that value-added tax is an indirect tax. We have transfer duty. Now, guys, when you buy a house, you will notice that there is always something called transfer duties. In order for you to transfer that house onto your name, there is a duty. And guys, there are many other taxes. Let me give you some examples of other taxes that was not mentioned there because they are not the main taxes. South Africa also have the e-tolls. So if you use their roads in the Gauteng province, you pay e-tolls. Now, what is an e-toll? For some of the students that went on the academic tour oh no, it seems like it's not you guys. Anyway, in 2019, the Accounting Society went on an academic tour to Johannesburg, and I also went with them. And we actually drove by bus, and these students saw how we had to pay. You can literally not enter that gate. It's like, let's say you want to drive to Oshakati. Then right before Oshakati, there is an e-toll gate. There's a gate, and you cannot pass through that gate if you don't pay the e-toll. Now, guys, at the end of our tour, people were really surprised that we had to pay so many times, that we had to pay these e-tolls. And e-tolls can, depending on where you drive in the Gauteng province. Now, guys, luckily, this is not in the Western Cape and at other parts of South Africa, but it is in the Gauteng province. Now, guys, the argument is that because you are using the roads, you need to pay those e-tolls, and the e-toll money will be used to maintain the roads and things like that. That is how they argue. Then, guys, another type of tax, can one of you just try? It was also introduced in Namibia, I think 2 years ago. What is that tax? There's another type of tax that we also have in Namibia. Can one of you just try? Which tax do you think is that? Anyone? Just try.
Sir.
Yes.
Is it not the black tax?
That one is very interesting because that's a term we actually came up. I'm also a black taxpayer, by the way. Anyway, no, it's not that one, but we'll talk about that one also. Anyone else that want to try? Guys, you will be surprised when you hear about this one now, because you guys are paying for it every day. If you go to the shop today, you will pay for it. What is that tax?
Sorry, sir, what was your question? Sorry, sir, I did not
The
get.
question is, there's another type of tax, and that South Africans pay, and that tax was also introduced in Namibia, I think 2 years ago. What tax is that? Anyone? Come on, guys. You pay for it every day. Okay, for the sake of time, I'll give it to you. A tax on plastic bags. That $1 that you pay, that is a tax. It's a type of tax. The only reason why it didn't make this list is because it's probably regarded as a very small tax. However, guys, it is a type of tax. Let me give you another one that is also applicable in Namibia. Environmental tax, guys. When you, I was very surprised in February when I bought new tires for my motor vehicle, and when I got the invoice, I saw environmental levy. Sometimes they refer to it as a levy or something like that. Guys, it's a tax, and there was an $11 on each tire. There was 11 Namibian dollars that I had to pay, which is actually extra, and that is a tax. That is a tax, a type of environmental tax. And then, guys, when I went to the Victoria Falls a few years ago, I saw that in Zambia and in Zimbabwe, there's even other types of tax called carbon tax. So if you drive by vehicle, you even have to pay carbon tax because you are polluting the air, and you will have to pay. Right at the border, you will have to pay an X amount because you are driving with a car and your car is polluting the air. Now, Namibia also introduced this carbon tax recently, and that is really bad for tourism because for me personally, I went with some friends. It was really bad for us because it was over $1,000 that we had to pay when we entered Zambia, and then again that side of Zimbabwe. At the Victoria Falls, you had to pay these taxes, and it's discouraging for tourists. Now, Namibia also introduced it. I don't know how far they are, if it was gazetted and so forth, but that is definitely that is backward thinking, because Namibia is such a tourist hub. We know the COVID-19 is posing a problem at the moment. However, tourism will return, and we should not be charging these people with all these things. Then, guys, there's even another tourism levy in Namibia that tourists already pay, and that is all taxes. I just wanted to reiterate, those are all taxes, guys. It is taxes. In South Africa, you even have the one that is also not here. There's even one called estate duty. This is where if you inherit money, okay, then you can actually be charged an estate duty. You will pay tax on that money that you inherit. Although some of these rates are very low and so forth, but these are all the different types of taxes. Then, guys, it's important that we distinguish tax between direct taxes and indirect taxes. So, guys, taxes are divided into two categories, either direct or indirect taxes. Direct taxes are charged on persons, and we know persons are divided into natural persons, which is you and me, and also juristic persons, which is companies, CCs, trusts, and even the estate of late. Okay, so that is also a juristic person. And one example of the type of taxes that these people or these persons will pay is, for example, normal tax. Then under indirect taxes, this tax is charged on transactions. An example is value-added tax. And guys, just to give you a clear distinction of what is the difference between direct and indirect tax. Direct tax just means that you as the person, you are responsible. You are directly responsible to make this payment of tax. While with indirect tax, we say you are not directly responsible. You are indirectly responsible. Let me put this in a scenario. When you finish your degree next year and you start working, you will be liable to pay normal tax on your salary if you earn an X amount above the threshold. Now, guys, you will be directly responsible. So the money will be deducted directly from your salary. directly from your salary, and the amount will be indicated there on your pay slip or wherever. So you see that is a direct tax. However, something like value-added tax, and I spoke about this last year when I gave you Financial Accounting 101 when we did value-added tax. We are not responsible to pay over that 15%. You as a customer of Pick n Pay, you don't take the 15% amount and then you go to the government and quickly go pay the value-added tax. That's not how it works. Pick n Pay collect the money on behalf of the government. So we are indirectly just paying it. We are not responsible. As an indirect taxpayer, we just give the full amount. Pick n Pay will pay it over to the government on our behalf. So that is the main difference between direct and indirect. Now guys, normal tax, and guys, this is the one that we will be dealing with this semester. It's the big one. I think that is why they gave them that name, that it is apparently a type of normal tax. Robert, you can ask your question. Yes, Robert.
Oh, sorry, sir. I just wanted to ask: is the tax on plastic not an environmental tax?
Yeah, it is actually a type of environmental tax. That's why I also gave you the example of the tires and all of that. So all of them actually falls under environmental tax. Indeed, you are correct. It is not a standalone. I think your question is it a standalone tax? No, it actually falls under the category environmental tax, because they want, the reason why we pay the tax is first of all to discourage us to use plastic, and second of all because they say it ends up in the environment, which is bad, by the way, and because you are actually polluting or basically harming the environment, and that is why you are paying that $1. And guys, some places are crazy. There's a place in Windhoek where a plastic bag costs $3 Namibian. I'm really, really surprised that this is the case. But yes, Robert, I think I've answered your question.
Yes, thank you, sir.
All right, let's continue. Please mute your microphone. Yes, thank you. All right, I think why they gave them this name normal tax, it's because it's the big one. It's that one that you will normally pay. Yeah? So we say this is the liability of a taxpayer. It calls for the annual payment. So guys, you will pay it per year. Every year you will be paying normal tax. So it calls for the annual payment of an income tax, which is referred to in the Act as normal tax. It is imposed upon persons. So once again, guys, remember juristic and natural persons, irrespective of whether they are natural persons or companies. Now, guys, please take note, when we talk about juristic persons, we normally say corporations, which include companies and close corporations or even trusts. Now, guys, in South Africa, trust is a big thing, where if you can afford it, you can open a trust, and you want to put some of your money in a trust for your kids one day, or even your beneficiaries. It doesn't have to be your kids. Then you just put that money in a trust, and that is why trust is also applicable in Namibia. They are very strict with trust these days, because people actually hide their money in these trust accounts, and that is why you also have to pay tax these days. It is payable on the taxable income. Now, guys, we will look at what is taxable income today. We will look at taxable income of the taxpayer for the year of assessment. Now, guys, very important, year of assessment. Remember, in financial accounting, we talk about financial year end. Now, just like financial accounting, tax also have a year end, but it's called a year of assessment. So in tax, we call it a year of assessment. Now, guys, there are two categories. The individuals, the natural person, have their own year of assessment, and the companies or the corporations, juristic persons, also have their own year of assessment. So let's look at the natural persons or individuals. So the year of assessment for an individual is the last day of February every year. Now, guys, we are already, as individuals, it's the same in Namibia, as individuals, we are already in the 2022 year of assessment. Why am I saying that? Because let's look at this example. For the 2021 year of assessment, for an individual, it would have ended on the 28th of February 2021. So you see the 2021 year of assessment. So what that means is it actually started on the first day of March 2020 until the last day. And guys, you must never use the word, you must never say 28 February or 29 February. You say last day of February. Why? Because we know February can have 29 days or 28 days, depending on if it's a leap year. So the year of assessment, last day of February. So guys, like I said, from 1 March to end of February every year, that is the year of assessment for an individual, and it's fixed, guys. This you can study. That is just how it is. Last day of February is the year of assessment for an individual. And the reason why I told you we are already in the 2022 year of assessment is because the 2022 year of assessment started on the 1st of March this year, and it will end next year on the last day of February. So the year of assessment for an individual will always start on the 1st of March and it will end on the last day of February. Let's look at companies because it's different for companies. So we say the year of assessment for companies, including closed corporations, is the last day of the financial year of the company ending during the calendar year in question. Now, guys, what does that mean? We are saying the financial year end, for financial accounting, that year end that we normally give you, where we say the year end of this company is 31 December, which is, by the way, not practical. A lot of companies don't have a 31 December year of assessment. But anyway, whatever, remember the company can decide, every company can decide when they want their year of assessment to be. When you start your company, you need to fill in this information and you give it to the government. And guys, you can even change it. As a company, you can even change it. Let's say it was 31 December, and then we get new management, and the new management decide, no, we don't want it to be 31 December anymore. And can someone tell me why is it impractical to have a 31 December year end? Quickly, before we continue. Why do you think it's impractical? Why is it impractical to have a 31 December year end for financial accounting? Or just a financial year end that is 31 December. Anyone to try?
So it's holiday and the companies are closed.
It's holiday, so Bino is saying, or is it Bino, is saying that it's holidays and companies are closed. Now, we have to be careful, you are correct, but we have to be careful to not stereotype, because some companies are open, isn't it? Ne? Like essential, like, you know, for instance, a private hospital and things like that. But yes, you are correct to say that most, that's the word I was looking for, most or generally companies close over the December holidays. Even those that were open the whole year, they normally close the 24th of December, and maybe they'll open in January. We've seen these notices on company doors and things like that. And guys, if you have a year end, let me just tell this to you. If you have a financial year end of 31 December, I'm telling you, you will be working on the financial statements, posting journals, posting all those things. You will have to do that from even in December. You will be doing some prep work, and 1 January you will start. So Robert, you have a question? Please go ahead.
Sir, and for example, income returns are due after a certain set period. I think the provisionals it's the first 6 months from the. But basically, what I'm trying to say is like at the end of the year, like for the full financial period, the income tax return wouldn't be due on the 31st of December.
Okay, that is debatable. You are correct to argue like that. However, let me just give you one thing. For instance, is that, like you mentioned, provisional taxes, right? Companies pay provisional taxes. And I don't want to confuse the rest of the students. But anyway, provisional taxes are due every 6 months, like you just said. Now, your second provisional tax payment is due at the end of the financial year. Now, how do you calculate that? There's actually a very complex calculation in terms of estimates and things like that. Now, how will you get to that amount if you didn't actually look at your records? Because you need to calculate, you literally need to have a preliminary trial balance and all of that. But I get you to say that the things, I think what you're saying is it's not due immediately. When your year end is 31 December, it doesn't mean that your financial statements need to be done on the 1st of January. I get what you're saying, but I'm saying there is prep work that goes into this whole process, like the provisional tax, for instance. And in large companies like F&B and all these places, they even need to already propose a dividend, okay? They even need to propose interim and even final dividends. And how will you get to these amounts? Because there are cut-off periods where it's not allowed anymore. For instance, dividends, where after year end, you cannot say that the dividend for last year or for the year of assessment, for the year end 31 December is 10 cents. You should do that on or before 31 December. Do you see what I'm trying to say? That there are certain things that need to be done, but you are totally correct to say that the financial statements is actually not due immediately. In fact, we have 6 months. That is even in terms of IAS 1 for financial accounting purposes. You even have 6 months to prepare the financial statements and give it back to the users of the financial statement. So I get what Robert was saying, that it's not immediately due. So I think what he's trying to say is that you can go on your holiday and only come back. But I know I've been in industry, and I can tell you now, sometimes as auditors, we even did, the year end would only be 31 December. We had this very specific client that I cannot mention the name for. You will be taught that in auditing this year that you never mention your client names. But anyway, so there was there's one client of ours that had a 31 December year, and we even did what we call an interim audit. Okay, as auditors, we did an interim audit, and that we used to do during December. That is even before year end. You already start with the audit, and those people could not go on leave because we were working and we needed to prepare those records. And then after year end, you even return to do the final audit. So just to give you an idea of how it works in practical terms. But like I said, I get what you were saying. Is that fine, Robert?
Yes, sir. Thanks for the clarity.
You want to add, or you don't agree, maybe? Because remember, you guys don't always have to agree with me. No? Okay, let's continue. So for a company, guys, the financial year of the company can end at any last day of any month. For example, the 2021 year of assessment for a company with a June 2021 year end will be on 30 June 2021. Now, guys, let's look at some of the examples. I'm going to ask you, so guys, what we say in this statement is the financial year end that the company have is automatically also the tax year end. So it's also the year of assessment for tax purposes. Now, guys, let's say a company have a year end 31 August. I need one person to tell me what would be the year end for tax purposes for this company. The financial year end is 31 August 2021. I'm asking what would be the tax year of assessment for this specific company. Anyone, quickly? Yes, Hendrina?
From 1st September to 31st August.
Did you hear my question? You are answering another question with the next question that I'm asking. My question now is, the financial year end of this company is 31 August. So my question is, what is the year of assessment for this specific company? Mukuvela, you wanted to say something?
31 September, the same date.
31 what?
September. What
Why
did you say?
I said August, 31 August.
Then 31 August, the same date.
Oh, all right, thank you, Mukavela. So, Andrina, that is the question was, because what I wanted you to say is that the financial year end is the same as the year of assessment for tax purposes. And that is the first question. Yes, the second question that I'll ask you now is, when did this year of assessment start? If it's ending 31 August, when did it, 31 August 2021, when did this year of assessment start? Now you can answer, Indrina.
The 1st of September, sir.
Which year, ne? Which year?
Yes, so which year is this? So is it 2021 now?
It's ending 31 August 2021. So when did it start?
1st September 2020.
Well done. All right. So thank you, Andrina. So it's always like 12 months back. Ne? It started 12 months back. You know how it works in financial accounting. If the year end is 31 December, then obviously it started 1 January 2021. And guys, the reason why I ask you these things of which year and things like that is, the reason for that is you guys also make these mistakes in tests. You don't give me the year and I have to mark you wrong because it's not a complete answer. If I ask when did it start, even if you say 1 September, that will be wrong because you need to tell me 1 September 2020, because I need to assess to see whether you know it is 12 months back. Okay, another example, if the year of assessment is 31 March 2020, that is the year of assessment end date, 31 March 2020, when is the year of assessment, or when did it start for that specific company? The year of assessment is ending on 31 March 2020. So when did it start?
The last date of February 2019.
Wrong. Anyone else? Let's see why Bukuvela is wrong. Yes, Andrina, you can try.
Yes, sir.
1st April 2019.
Well done, Andrina. Mukuvela. So quickly look at that one. So the end date is 31 March. So which 2020, which means it started the previous year, 1 April 2019. Yeah, okay. So don't get it, those ones wrong. All right, guys. So like you see with companies, it's a little bit different as for individuals. For individuals, it's always first day of March up to last day of February. However, for companies, it can vary because the year of the financial year end is also the year of assessment. It's also the tax. Guys, there is a distinction between a tax year of assessment and the financial year of assessment. You will see that there's even a difference. You know, in accounting, we call it net profit, for instance. In tax, we call it taxable income. There's a huge difference between a net profit for financial accounting purposes and a taxable income for tax purposes. But for tax purposes, in terms of year of assessment, we say the financial year end that the company selected is also the tax year end, or the year of assessment, as we call it. Then, guys, this is how we calculate taxable income. This is what we refer to as the framework. Now, guys, all our calculations this semester, we will use this framework to calculate tax. So basically, this formula, the starting point is this framework, and you need to know this by heart. So we will start with gross income, less exempt income, and that will give us income. Now, guys, once again, I just need to reiterate, there is a difference in definition for income in tax as there is a definition for income in financial accounting. You know, in financial accounting, in terms of the conceptual framework, income is defined as increases in economic benefits and things like that. For tax, income is gross income less exempt income. That is what income is. Guys, if I ask you a question, a theory question in text where I say define income in terms of the Act 58 of 1962, then I don't expect you to tell me income is when I work and I get money, then I have income. I don't want to hear those stories. That is not what I'm looking for. Income is, for tax purposes, gross income less exempt income. Then we will have less deductions, allowances, and amounts to be set off against income. Then we will add any CGT, capital gains tax, and that will give us our taxable income. And guys, like the name say, this is the income that will be taxed, okay? Because, guys, there are certain things in financial accounting that we deduct as expenses that is not allowed in tax. And, guys, this is a very important part, especially for financial accounting 202. You guys are registered for financial accounting 202. There's one chapter that you will be dealing with, which is called income taxes. Guys, it's actually this part here. So whatever you can pick up in this class, take it to financial accounting 202. Let me give you an example of one thing that is deductible for financial accounting purposes, but it's not deductible for tax purposes. Let me give you an example. Fines and penalties. Okay, if we get a fine, you know, let's say you actually told your driver, your company driver, quickly go get me those papers in Northern Industrial, and you know the speed limit in Windhoek is 60 kilometers per hour. Let's say he drives 80 kilometers per hour and he gets a fine of $1,000 and the company, you guys agree with me, since we sent the driver, I know some companies will be like, it's your fine to pay, but let's say in this case, the company paid for it. Now, for financial accounting purposes, under expenses, you will deduct that fine. You will say, I've paid the fine, it's an expense, and so forth. For tax purposes, that will not be allowed. You will not be able to deduct that 1,000. Can someone tell me, why do you think we will not be able to deduct that for tax purposes? Why is a fine like that? Why would it not be deductible for tax purposes? Anyone? And then we can end there for today. I'll open the floor for questions. Why do you think a fine, a penalty, a fine is not deductible for tax purposes? Anyone? Just try. Just try. So some of you just come here to breathe, huh? You never participate. You just sit there and you breathe. Huh? It's a good thing because you are not harming anyone, but it's not a good thing for learning. So why do you think a fine will not be deductible? And I want you to think critically about this. Let's look at the root cause. Why did you get that penalty? Answer that quickly. That's easy. Why did you get the $1,000 ticket? Anyone?
For breaking the law.
For breaking a law. All right. So thank you, Denver. For breaking a law, you got that ticket. Now, does it make sense if the government want to punish you? Remember, that's a punishment because you broke a law, like he just said. Okay. Now, does it make sense that you broke a law, you have to pay for it, and then you now deduct that amount for tax purposes? Do you see that you will actually benefit from that? No? If you deduct it, because remember guys, all these deductions will make your income less and there will be less money to tax at the end of the day, which means that you actually benefited from paying that, or basically not benefited, but it means it will actually smoothen out. You will not be punished anymore because now you are even getting, it will become zero again, isn't it? And that is why a penalty will not be deductible for tax purposes. Now, guys, we can end there for today. I will now open the floor for any questions relating to the work that we've covered today. Any questions before we end this recording? Is there any questions?
Yes, sir, I have a question.
Yes, Mukuvela, go ahead.
Like on the framework for calculation normal tax.
Yes.
Like what if I have like assessed loss brought down for the previous year? I can end it or I can less
All
after
right.
ending
So,
the taxable portion of gains of the gain.
all right. Thank you for your question. So, yes, assessed loss is deductible for that year, but it doesn't fall into any of these categories because after taxable income, remember I told you this is the income that can now be taxable, that can now be taxed. But after this, we are not done. I'm trying to tell you, we are not done. There's still things happening down here, like for instance, rebates. Did I make any provisional tax payments already? Like our friend Robert said earlier, companies pay provisional taxes, and then even yours now, assessed loss. And that assessed loss is normally here at the end where you can actually have it as a deduction. All right. So indeed, yes, to answer your question, assessed losses is deductible. Okay, but it's normally not in this part here. It is a little bit as you go down. But yes, assessed losses is a deductible expense. But what are the criteria? I can see that you know a little bit about assessed losses. There is also criteria for tax purposes. You cannot just deduct any assessed loss. Can someone tell me why do you think, what is the criteria for you to actually deduct that assessed loss? It's an accounting definition that you need to know. So what do you think is the criteria for you? Because what I'm trying to say is not all assessed losses are deductible. Okay, generally assessed losses are deductible, but not all of them are deductible because there are certain criteria that must be met before you can actually deduct that assessed loss. And what is that criteria? Someone quickly. All right, for the sake of time, I'll answer that. So guys, what happened is in the financial statements, just check if that company had an assessed loss that they have deducted. They normally write down a note because they need to actually explain why they actually deducted that assessed loss. And the criteria is that future economic benefits should be possible, you know, in future. Like you know the definition of what assets used to be. Remember, assets doesn't have that criteria anymore, or it's not included in the definition of an asset anymore. But an assessed loss for tax purposes is actually seen as an asset for a company because it's deductible, it will reduce the liability, and the criteria that you need to assess this on is that, will this company still continue in the future? Let's use an example of Air Namibia. I know it's not the best example because they are anyway state-owned and so forth, but let's say they were a private company and they also made, you know for a fact, they made losses in the previous year. Do you think they should have deducted the assessed loss last year? Do you guys think so? The answer is no. Why? Because already last year, you know, NMB's business was shaky, so much so that it even closed this year. So future economic benefits will, you know, the principle of going concern, you know, will they still operate? Will they still make money? Will they make profits? No, future profits. No, because they will close down. And for a company like that, they would not have been allowed to deduct that assessed loss. However, if you know that even if we don't say next year we will make profits, but we say in the next 3 years or so we will make profits, you will be allowed to deduct that assessed loss. They are also applying, just for interesting sake, they are also applying what we call ring fencing. Ring fencing is that after a certain number of allowed to make losses anymore, and then you will also not be allowed to deduct that assessed loss anymore. Mukavela, I hope it's a lot that I just said, and it's also a lot beyond your scope. These things we will not be looking at this semester, we will only look at it next year, but I hope I've answered your question.
Yeah, thank you, sir.
All right, so guys, unfortunately our time is up. I will now stop the recording and then we will continue with this lecture on Monday. Like I mentioned already, this chapter is for 2 weeks. We have to talk about this for 2 weeks, but you can already look at the tutorial. You can already look at the tutorial question. It's really just true or false questions that you can already answer because we have covered half of the lecture already. And next week, Monday, we will continue with this lecture. Now, thank you for coming.
Sorry,
and